Our market master of the day is with us. He's Nilesh Shah, Managing Director and Chief Executive Officer at Envision Capital. Nilesh, it's always a pleasure welcoming you here in the studios. Thank you very much.
Thank you. Thank you so much, Prashant.
How are things looking, Nilesh? Is the worst behind for global markets? Because, I mean, we didn't see very much of the worst here, at least on an index level. There's been great outperformance. But is it looking a little more constructive as we wrap this year up?
Oh, absolutely. I think it's heartening to know that we've had a strong pullback from the lows that we saw in the middle of the year. It looks like there are a lot of concerns around inflation and growth seem to be now kind of finally ebbing. And it looks like that we're set for a good kind of the next 1 year or so from here onwards.
Okay, that's a great way to start the interview, Nilesh. Always a pleasure speaking to you here. I wanted your thoughts on a sector that you've tracked for so long, right? IT, because now the valuations are looking a bit compelling and there's a cycle that every sector goes through. You think the worst of the down cycle in IT is now behind us?
Absolutely. Clearly believe that the lows that we've seen in 22, I don't think we're going to revisit those lows. What it looks like, I think, is from the kind of layoffs that we are seeing in the United States. Finally, the indirect fallout of that is going to be essentially a better environment for hiring, better environment for wage costs. That, in a way, will provide a strong cushion to the margins of IT companies. While growth for the next 3 to 4 quarters could still be on the lower side of the range, but I think that's probably going to be a more transient kind of a phase. And maybe 2 or 3 quarters from now, you'll see again, IT come back very, very strongly. And like what you said, I think the valuations are very, very attractive. So you're going to see a combination of growth coming back, margins coming back, and then, of course, valuations being attractive, perfect for growth investing.
All right. Hi, Nilesh. Good to have you in the studio and meet you in person as well after a while. Well, what about the new age themes? Someone thought that there was value a few years ago, in the pre-IPO round. And some of these stocks are way below, one of the first few rounds as well. Some of these themes, they could become attractive at some point of time. But when? How much more downside are you assuming? For the notable names that are getting a hard knock is Nykaa as well as Paytm. Nykaa, everyone was gung-ho, I remember. Suddenly things have turned around. That corporate action hasn't worked in their favor. Now these resignations. So what's your take?
Well, clearly, of course, the fraud that we saw on pre-IPO or IPO or even post-listing, that is kind of completely gone out. Yeah. Some of them have essentially mended their business models to ensure or guide for a path to profitability. So that's like kind of heartening. A couple of them continue to deliver very strongly on growth. And that, again, I think is great news. Unfortunately, a few of them have essentially not indulged in the best of kind of corporate practices. And that's taking a toll. But having said that now, what it looks like is that the valuations are attractive, especially for a long-term investor. I honestly don't know how these will behave over the next few quarters. Yeah. But if you have maybe a 2 to 3 year kind of outlook, I wouldn't be surprised if these end up delivering some solid returns. Not all of them, but maybe just to select 1 or 2 out of them. Currently, in the very short term, the pressure from essentially the investors who came in the IPO or pre-IPO, I think that pressure will continue because they all need to book some profits or whatever profits are left out there for them by the year end. They all need to basically shore up their P&Ls and all of that. These are global investors. I think once that passes, I clearly believe that I wouldn't be surprised if 23 we see some fair bit of outperformance from this pack.
Among them, which one would be top of the list for you?
So the one that we own, I think, is PB Fintech. They have essentially demonstrated strong growth. They no longer are having any cash burns.
Yes.
They get basically adjusted EBITDA break-even by Q4 of this year. And they've guided for reporting accounting profits next year. Leadership continues, 90% plus market share. A bit of the environmental or the regulatory risk remains in terms of how Bima Sugam will play out and what it means for their economics. But otherwise, I think that seems to be a kind of a great name. They have been able to manage competitive intensity relatively well. So that's probably a standout one among the entire kind of pack.
But that Bima Sugam could be a big one, right?
Yes, that's the big overhang.
That kind of straight away attacks the commission structure for companies like the aggregators, basically.
Yes, the only thing, Prashant, is we really don't know how long that will take to play out, what it will actually imply, how does that change the terms of the trade, how that change the competitive landscape. One has to see. I think at times what we also think is that every initiative will become like an UPI initiative and will disrupt everybody. May not. The reality is that insurance business requires a lot of hand-holding. And I'm not too sure whether entirely having a monolith or a monoline model of just online will help or not. Keep in mind that even Policy Bazaar had to gravitate towards also the offline or the physical model, because you need the agents out there to help you while you're claiming your health insurance, your life insurance, all of that. So you need that support system. So I'm not entirely sure why. I don't rule out the impact of that, but we'll have to see how that plays out.
The price is already significantly corrected.
Oh,
so
absolutely. I mean, look at the current market cap, 16,000 crores. Basically, if you split it between the two, Policy Bazaar, Paisa Bazaar, 8,000 crores, 8,000 crores. That's $1 billion each for a unicorn. I'm quite sure as a private investor, if you were approached, you would happily kind of give it the status of a unicorn for both the two pieces. So maybe that's one way of looking at it. And then, of course, if you look at the kind of 3 to 4 year guidance which they have dished out, and if you kind of put some numbers to that, I think there's a lot of value on the table.
And just to add on to the point, I think the supply overhang is relatively less as well out here. That's a sense you get on
Yeah, Nigel, but those are things which are very hard. I mean, we might today say that there's no supply, and this evening we'll
Suddenly
probably
get
receive a message saying there's an offloading. So honestly,
That's
it's hard to take. But I clearly think that the business leadership is intact. Cash burn is no longer there. There are strong cash flows. And of the 16,000 crores, they have 5,000 to 6,000 crores of cash. I don't remember the exact number. So you're talking of a number which is way lower, and probably they've talked about that a year from now, they'll start probably thinking about paying back cash to shareholders. I don't think there's any other new age company which is thinking like that. So for me, that's why that's probably a standout name amongst that pack.
What about Nykaa? Because, over there as well, right? I mean, the stock has halved this year, but the business model is still strong. They have a dominant market leadership in the space. There's a first mover advantage. They are profitable, and the earnings as well, the recent quarter earnings were not too bad. There was a pickup there. So is this also in one of your lists of, buying stocks at good value?
It's there on the radar, it's there on the horizon, but I'm not too sure that it's made it to the buying list. That's because I think the competitive intensity is kind of going to go up for them. There are two areas. One is the core business. You're going to witness more competitive intensity as the bigger names essentially up the ante and kind of, bring about a lot of competitive pressure. So that's one. The second side of it is that, of course, the adjacency that they are addressing, which is the fashion business. One has to see again, that's again a competitive segment, and how that will play out, what it means, what are the incremental investments that they will have to make over the next maybe a year or two to build the critical mass. These are some of the things which we will have to be kind of watchful about. I think if they pass this hurdle, it's quite possible that also ends up being a nice, good long-term investment.
Okay, so that's on Nykaa. But where else do you see, alpha generation now? I mean, you were speaking about how IT could be a very good play over the next couple of months as you look at buying growth stocks, right? Where else?
Clearly, this time around, or probably over the short to medium term, growth is going to be in a lot of manufacturing-oriented sectors. I mean, of course, defense has played out well. The product guys in capital goods segment, I think that segment is kind of doing well. Order books are still kind of holding up. For some of them, they are swelling, so that gives a lot of visibility. Auto components, some of the companies out there, especially the smaller ones, have managed margins really well. And I think if you've been able to hold on to your margins in Q2, it's very likely that you could probably even improve upon your margins for the rest of the financial year, or maybe for the next of the few quarters. So these are some of the manufacturing-oriented pockets, which I think, again, look extremely attractive from a 1 to 2 year perspective.
For all the rise in share prices, P multiples are still 18, 20 times broadly, right? FY24 earnings. Actually, not just Mazgaon, we should put up Cochin and Garden Reach as well. These are three of the top volume-led gainers today. Even as we continue this conversation with Nilesh, Mazgaon, Cochin and Garden Reach. And just one more name is TCNS Brands. I mean, it's a big move on TCNS Brands. There's a news flow. Our colleague Nisha reported that they were looking for M&A activity, looking to sell. The promoters were looking to sell. 7.5 higher on TCNS. That's 600 on the apparel maker at this point in time. Insurance is a space, Nilesh. Do you own anything there? Any views in particular? I mean, I was mentioning Max earlier, where we've seen so much price damage.
So it's again a very exciting kind of space. Probably it's the one which has probably the best longevity in terms of a business opportunity. But I think we're basically veering down to a conclusion that it's better to own essentially the distributor, the market aggregator, etc., because you then become agnostic to whose insurance policy sells. Finally, what matters is the policy selling. Doesn't matter whose policy sells. And I think from that perspective, PB Fintech or Policy Bazaar is a great proxy for the insurance space. But having said that, I think the top 2 or 3 insurance companies will also do well over the long term. I think, of course, valuations are a bit challenging for them. and a bit of the movement in terms of bond yields and all of that does impact their profits in the very short term. But otherwise, I think from a structural perspective, these are great investments to kind of bet on.
Okay, all right. And, my colleague Sonal, she says that it's around 5,100 crores in terms of their cash as of March. That's on PP FinTech. What about the pharma space, Nilesh? The headwinds continue on pricing in the US, but the hope is that at some point of time this will wear out, and maybe 2023 finally things can start looking up on the pricing aspect. Maybe it will not be such a big erosion. Your take on the space?
Nigel, I think that's probably been the most disappointing kind of sector in terms of performance, especially from if we were to kind of look at the COVID environment and where we all thought that over the next few years, pharma is going to be a standout sector, and that has unfortunately not played out that way. And I don't see yet any kind of silver lining out there in terms of, the pricing. I think it's still a hope trade that, too much of the pricing erosion has happened and all of that. But I still think overhang in terms of pricing, in terms of regulatory stuff, in terms of margins, they still kind of continue to kind of be there. The reality is that there are, way many more number of other opportunities, many more other sectors which are today firing or at least are expected to do much, much better, especially on a risk-adjusted basis. So I'm not too sure whether pharma, it's not gone anywhere, but I don't think it will go anywhere.
Okay. Give us some ideas. I mean, it's the end of the year, right? So generally when it's Diwali, when it's New Year, we ask for some ideas for the next year. What are you looking at? You spoke about themes, but tell us about stocks.
No, I think clearly next year, I would probably think that some of the IT companies could do well. We've been owning L&T Technology Services for a while now. And if you look at the latest earnings call, where they have basically said that they've hit $1 billion run rate. And by FY25, they expect to hit a run rate of $1.5 billion. That's like a kind of a 50% increase in revenues over the next 2 years. I mean, I can't think of any other meaningful IT company kind of growing at that rate, especially in this kind of an environment. So that kind of looks pretty good. Some of the offbeat financials look good, be it the tier 2 banks, be it some of the mutual fund distributors, some of the online brokerages. I think that to me still continues to be a...
name 3 names there?
We own Angel. I think it's one of the ones from the 2020 IPO, which we've been owning it post its IPO listing.
Okay.
Done well. The business continues to kind of perform really, really strongly. A bit of the regulatory overhang is there in terms of, would there be caps in terms of derivatives, F&O, but those are all very standard business risks. But I think the business continues to execute really well. One area which I think could probably be again a standout for 2023 is the packaged food segment. They all have got, the margins have got crushed under high, raw material prices and freight and packaging costs and all of that. They all have responded by taking price hikes and doing grammage alterations and all of that. What we own out there is Mrs. Bector. I think they had a stellar quarter. The first half had fantastic revenue growth. Expect some bit of the revenue growth to sustain, margins to come back. The other name that we continue to like in this space is Pratap Snacks. I think it's attractive. Margins completely beaten down, but they have guided for almost a double-digit margin, which I think could be very meaningful for their earnings. The third, of course, we continue to like is the alcoholic beverages space. I think Radico Khaitan is doing brilliantly out there. They're kind of undergoing major capex. Margins are subdued, but I think 4 quarters, 6 quarters out there, margins coming back, capex completely executed, significant de-risking in terms of raw material sourcing, and of course they continue to grow. I mean, you have a business which is growing at 20-25% for the prestige and above segment. Hard to find businesses in the consumer space growing at that pace.
What about these QSR companies? I mean, since you were talking about management interviews, we interviewed Westlife recently, and they are so optimistic. They're opening, stores left, right, and center. What about like the Devyanis, the Jubilant Foods of the world?
Sonia, great. I mean, of course, these are going to have long-term potential, but just 2 or 3 things. I mean, I think the black swan events can always be lurking around there. I mean, suddenly the principal, the parent doesn't like you, saying, okay, fine, I don't want to have you as a franchisee. That's a huge black swan event. Suddenly they'll up the royalties and that will impact your margins. Third, capital intensity. I mean, you need to keep opening stores and you need to keep investing in these stores. And finally, valuations. I don't think valuations are too attractive. They don't give you, comfort from that point of view. So yes, growth, but I'm not sure if the price is reasonable.
Always good chatting with you, Nilesh. Thanks so much for coming down. Wishing you a good day and good trading session ahead. Look forward to having you in the studio.
Thank you so much.
Yet again. Well, let's move on then. A bit of a boost came in